Good afternoon. It is October 2nd of 2023. It's 1 p.m. here on the West Coast. So let's go ahead and get started. So September was a pretty rough month for capital markets. We saw the S&P 500, the NASDAQ, whatever sort of index you're looking at, get hit throughout the course of the month. One of the worst months that we saw there in terms of index performance since the month of March, where we had the regional banking crisis. We're going to talk about the ongoing rise in interest rates. I think that's a really important topic that we want to keep focused on because it's driving a lot of what we see in terms of asset flows, in terms of day-to-day market action. But I think also setting the market up for a structural shift in how we're looking at valuations and where we're looking for opportunity, value versus growth. And it's this idea of if rates are going up, are they staying up? And that's the billion-dollar question. Are they staying up, or are we merely going to go right back to where we were 2 years ago? Lots of indications out there that suggest we're higher for longer. Not to borrow that pun from the Fed too much, but realistically, when we look at those long-term charts, that's a lot of what we see. So enough pontification there. Let's go ahead and get started for the week. As I do every week, I'm going to go ahead and share my screen here. Investing during stagflation. Stagflation is that term that we've used quite a bit. And we think the more we get into this cycle, the more evidence there is that we are certainly more confident of that call of stagflation. We see it with oil prices, we see it with consumer prices, and then we see growth sort of slowing off the boil a little bit here in the back half of the year. So 3 big things we want to focus on. Where do stocks stand after that September move lower? Now, for clients in our growth portfolios, you'll notice that September was not a down month for you, but we'll go through why that was. Number 2, the prospect of long-term rates above 5%. No one on Wall Street right now is really forecasting above 5%. You get the individuals that are, no strategists are at this point. Well, let's look at the possibilities of either they do or don't go above 5%. And then lastly, 2 sigma move for oil this past week. And as you know, we've been talking about oil week in, week out for the better part of 6 months. What does it mean? What does it mean for the stocks? What does it mean for portfolio design? We'll go through all of that this week. So that corrective process in the stock market is ongoing. We see it here with the broader indices. So when we look at the S&P 500 here, we can see we've had about a 7 to 8% pullback in those headline indices, such as the S&P 500. Now, last week we talked about support in around the 44.58 level. That did break this week, and we moved lower. Now we see sort of 4,200 is that new line in the sand for support before you would see another leg lower. 44.58 now becomes resistance, right? So that's typically what happens is previous support becomes new resistance on the recovery. So we would look for, and pardon me, it was actually 44.58 where that resistance and that prior support was. So as we get closer to 44.58, a potential counter trend rally in this correction, we want to be careful around those levels. So that's something we're continuing to take a look at. Very short term here, we are oversold. So don't be surprised if we see a few days where the market bounces. Probably see technology stocks, leads, utilities, REITs, those areas that have been at the center of the storm. Don't be surprised to see those things bounce at the forefront. But underneath the surface, we continue to see the percentage of stocks, as this third chart here shows, the percentage of stocks above the 200-day moving average continuing to deteriorate, right? So you want to see expanding breadth with a healthy rally. We haven't quite seen that. Even with the rally earlier this year, we never got above that 80% of stocks above the 200-day moving average. That's a little bit of a yellow flag, as I would say, not a red flag, but a yellow flag. Especially after a bear market, you want to see that get above 80%. Right now, sitting in that 41% level. Fortunately, we're not in a lot of those areas, and we'll go through why that is. But the way to sort of think about this is focus on the emerging areas of stock market leadership, right? Even if you don't want to make a market call, where should you be deploying those dollars within the market if you're less time sensitive? So when you look at poor market breadth, I thought this chart did a really good job. And this is from one of our vendors that we work with called Worth Charting. And what they show here is the Russell 3000. Now, this was before this sell-off over the last week. So a couple of percentage points lower here in terms of percentage performance metrics across the board. But we saw the Russell 3000, which is your most inclusive stock market index, includes almost every single stock on the NYSE. And you can see here, it's up about 14.9% year to date. What's interesting, though, is that the average stock is up 6.9% year to date. And the median stock, so when you sort of split stocks evenly across both to the left and to the right, the median stock is up only 0.1%. Now, this will come maybe not as a shock, but maybe as a shock to some, is that 50% of the Russell 3000 is actually trading below the lows of last October, right? So October 2022 was when we saw the bear market low. 50% of the stocks on the Russell 3000 are actually trading below those levels. So what's the message here? Well, the stock market breadth is very poor. And we see that with the S&P 500 as well. So the S&P 500 price index is up 11.99%. But the S&P 500 equal weight, so in other words, when you remove the outsized impact of Google and Facebook and Amazon and Netflix and Tesla, outside of those 6 or 7 stocks, that S&P 500 equal weight index, where each of the 507 stocks or so on the index have an equal weight, it's only up 0.55%. And I believe it actually may be down by the time that we are recording this year to date. So very telling in terms of the poor breadth that we're seeing in the market. Now, a lot of this is being driven by the interest rate market. Cost of capital is moving higher, valuation shifting lower as a result of that. Why? Because a lot of companies have to defer projects, right? Because they don't meet those hurdle rates in terms of payback periods. So are interest rates overbought yet is the key question. No one is forecast. So short term, yes, they may be overbought, but long term, there's still a lot of people fighting the tape. We see vast amounts of inflows into long-term treasury funds, such as the TLT and other long duration funds, as people are trying to time the peak in interest rates. So we haven't seen a flush lower in terms of outflows there. People are still trying to time the top in interest rates, which tells us that the pain trade remains higher. And when we look at the breakout that we've seen in the 10-year interest rate here, basic technical analysis math shows breaking out of this range gets us to about 5.25%. So when we look at the duration of the consolidation, the breakout, that gets us to about 5.25%. And what's interesting is if you look across all the major sell side or Wall Street strategist forecasts, not one has a forecast north of 5%. So, it's this classic fighting the tape, trying to time the top or the bottom, and no one thinks something can go above a certain level. Sure enough, Wall Street has a funny way of getting to those levels. So very telling here, back when rates were at 1%, no one had rates going north of 2%. I would not be surprised to see us north of 5% here over the coming weeks and months. So the question then becomes, how do you invest during times of rising interest rates? We've talked about this and we've looked at this chart last week, and then I think probably a couple of weeks before that. And what we notice is that oil tends to act very well, as do other commodities, during times of rising interest rates. Why is that? A lot of reasons, right? Commodities have better pricing power. They shift higher in response to higher inflation rates, but also they shift higher in response to perhaps a falling US dollar, which that part hasn't really been the case lately, but mostly in response to inflation. And so the other area is that there's more projects that are taken offline in the energy space, right? So if that break-even rate was $50 before, well, that break-even rate now is $75 a barrel. So it just provides a nice higher floor for break-even rates, which takes a certain amount of production offline in the future, pushing up the price of oil. And of course, OPEC continues to turn the screw on supply as demand continues to increase both in the US, Europe, and in China and India. So again, we want to be very mindful of rising rates. How do we invest? Historically, what tends to outperform during times of rising rates? Because you can make money, right? I think that's important to know. The market doesn't trade as a monolith, right? Technology, which is hurt by rising rates, does have a tendency to underperform during rising rates, right? Like they're a big chunk of the market. Technology is over 30% of the market. And if you include communications, you're up closer to 40%. So if you have 40% of the market that structurally struggles in rising rates, the index is going to appear to be struggling, but there are pockets of opportunity. And we can see it was a big week for oil. We had a 2 sigma move on the price of oil. We got over $90 a barrel. That was resistance, now acting as support. The stocks themselves are breaking out of similar long-term bases. So you haven't seen a parabolic move to suggest that the stocks are getting ahead of themselves. In fact, many are just starting to break out of last year's peak price levels. So why is oil acting so well when there are all these macro concerns, these monetary policy concerns, interest rate concerns? Why is oil acting so well? And quite frankly, there's no supply. So we're getting close to now minimum operating levels. So we put out a weekly update back in late July that talked about August being a major inflection point for oil inventories. And since then, we've seen a major collapse in oil inventories. I'm not talking about the emergency SPR reserves. We are talking about the functioning oil inventories that we use on a week-to-week basis in the private economy. And so we're just seeing a major collapse in inventories as denoted by this white line here. And if you annualize, you take the seasonal adjustments, right? And you say, okay, well, maybe we always have low inventories during this time of year. When we compare it to other years, the purple line here is this year's inventory levels compared to other years. And you can see right here around July, we just start to collapse. And a big reason, rising demand, no response from shale producers in the US. And there's a number of reasons why. And all that's translating into energy outperformance. So when we look at all the sectors right now, almost all of them are in weak momentum. Still, a lot still has some strong trends, long-term trends. But the only sector right now that has a strong long-term trend in terms of price combined with strong short-term momentum is energy. And we are followers of price. We like to look for leadership with fundamental factors that can continue that flow, that persistence factor. And energy is the one that majorly checks off that box right now. And quite frankly, commodities continue to appear cheap. So going back all the way to 1900, we've shown this chart probably 25 times, but commodities are just structurally undervalued at some of the lowest levels in 120 years. And we believe this is an area where we can structurally outperform for the next few years, and consumer stocks will continue to struggle as a result of that. So wrapping everything up, we believe the path of least resistance remains upward for interest rates and for oil prices. And we have positioned the portfolios as such. You know, watch out for those weak areas of the market. No need to go bottom dipping here. If anything, what I would be looking for are stocks that are acting well outside of energy in an otherwise really bad tape. So there are a couple stocks that we bought into the portfolios this week. What I would say is look at those stocks that we bought, look at the charts, look at the chart of the S&P 500, and then ask yourself, well, why is that acting so much better than the rest? And we ask ourselves that same question. And there's some interesting fundamental stories that are setting up. It's a stock picker's market. Oil breaking above that key resistance, we're going to stay focused on trend. And 5.25% remains a key target for us on that 10-year treasury yield. So that's what we got for you this week, 888-543-3776. Hope everyone has a great week, a great October. And if you have any questions, please feel free to reach out to your advisor. Otherwise, have a fantastic week. Thank you again.